Hello friends, welcome to GCC FinTech's webinar on transfer pricing landscape in Middle East. Big thanks to all of you for joining in today. We'll be starting the webinar in next 2 minutes, and I'll just take you through the course of today's webinar. Our guest speaker, he will talk about transfer pricing in Middle East. Then we'll discuss arm's length standard, transfer pricing documentation, compatibility and benchmarking methods, followed by question and answer sessions towards the end. You can use the chat facility to type in questions, and we'll take the questions towards the end. It's time to welcome our guest speaker, Gaurav Garg. Gaurav is a transfer pricing expert who has been working in the field for last 16 years. And till date, he has delivered almost 700 sessions on transfer pricing and international taxation. And we also intend to launch a course on transfer pricing for our Middle East audience with Gaurav soon. Gaurav, over to you.
Very good morning, Anu, and to all the participants in today's webinar. It's great to address Middle East audience on transfer pricing. Let me thank GCC FinTechs for this wonderful opportunity to interact with all of you and to share my transfer pricing experience, which hopefully will going to assist you in doing transfer pricing compliance in your local country. So let me share my presentation. Hope my screen is visible. Anu, if you can please confirm.
Gaurav, we can see it.
Okay, so I'm see the agenda, or how we're going to proceed in today's presentation would be, I would be starting with the introduction and then understanding what arm's length principle actually means, then broadly discussing transfer pricing process that one needs to follow when transfer pricing law is applicable. What are the different transfer pricing methods and key attributes of those methods, and how you can use those methods while doing TP documentation. And then certainly transfer pricing documentation, we have 3-tier transfer pricing documentation. So I would be discussing broadly about all 3 types of transfer pricing documentation. Then a broad discussion on the current setup of TP regulation in different Middle East countries. And towards the end, we would be taking up question and answers. So let me start. Anu, should I start, or do we need to wait?
Gaurav, we can start.
Okay, thank you.
Thank you.
So, these 2 terms, transfer price and transfer pricing, is very important to understand, and because we would be using these 2 terms very commonly, not only in this webinar, but also if you're handling transfer pricing of your company or of your client. So these 2 terms becomes very important. So transfer price, as the name suggests, this is a combination of 2 words. One is transfer and second is price. So it means a price charge in a transaction. So a price charge in a transaction between 2 parties, and from tax perspective, those 2 parties means 2 related parties, and we often call them 2 associated enterprises. So it is a transfer. So something is getting transferred from one related party to another related party, or from one associated enterprise to another associated enterprise. The transfer could be of goods, the transfer could be of services, the transfer could be of intangibles, the transfer could be of tangible, anything, depending upon law of a land. But in general, all kind of transactions are covered within the purview of transfer pricing. Now, what is transfer pricing? So As we said, transfer price is the price at which transaction is taking place. So transfer pricing is a mechanism to compute transfer price. So when it comes to tax, transfer pricing means price which you need to adopt, or a mechanism that you need to adopt to derive a price for your income tax return. So in general, I may be transacting with my AE, with my associated enterprise at some X price, correct? But for tax purposes, what should be the price is something I need to find out, and that I can find out by following transfer pricing. And that's why I'm saying it is a mechanism. It is an exercise that we need to follow. Now, to take an example, where it is applicable, or to take an example, we can take let's say we have two countries, country one and country two. In country one we have parent company PICO, and in country two we have subsidiary company, and there is a transaction between parent company and a subsidiary company. So the tax authorities across the globe, not only for a transaction in between parent company and a subsidiary company, but in general, between various group entities which are controlled by common management, or common equity holders, they want to check, the transaction price adopted by a group for these transactions, is fair enough to give them a good share in the tax. Because whatever be the price, it will impact the income of both the companies, parent company and subsidiary company. So the tax authorities of parent company would like to protect their share of taxes. Similarly, tax authorities of subsidiary company would like to protect their share of taxes. So, we may find transparency regulation in parent companies jurisdiction, or in subsidiary companies jurisdiction, or we may find transparency regulation in both the countries. Now in Middle East also, we there are we the countries are coming up with transparency regulations. We're going to see at the end what is the position as on date. But if you talk about globally, I think almost all developing economies or developed economies, they do have transparency regulation in place. So broadly, from tax perspective, we have two mechanisms to compute transfer price. One is globally formally apportionment approach, and second is arm's length price approach. As you all know, most of the countries, or to say almost all the countries, follow the arm's length price approach. But it would be equally important to understand the global formulary apportionment approach before we move on to arm's length price approach. So under globally formulary apportionment approach, the whole group is considered as one, and whatever the total profit of the group or total losses of the group, that gets divided among different entity based on certain formula. So if my group, if I consolidate the balance sheets, and if my group is into profit, then each entity will get some profit out of the total profit. But whereas if my group is into the loss, each entity will get some portion of loss. Whereas if I talk about arm's length price or arm's length principle, whatever may be the consolidate the profit or loss situation of the group at the consolidate level, each entity in the group gets return based on its contribution to the value chain. So it may happen that at a consolidate level, the group is having insignificant profit or very low profitability, or maybe into losses. But the entity, let's say, which is a captive manufacturing unit, needs to be compensated, or is getting a good compensation based on the functions that entity is performing. So, for example, one may be remunerating captive manufacturing unit at the cost plus 5%, whereas overall the group may be into loss of, let's say, minus 6%. So, under arm's length price approach, we cannot take a stand that being my group is into the loss, I cannot remunerate my captive units, or my other companies? The reason is very clear. We are following arm's length price approach and not global formulary apportionment approach. So under arm's length price approach, each entity is considered as a separate entity, and each entity is remunerated based on its contribution to the transaction. Now, what is arm's length principle? It is very important to understand what is arm's length principle. We are saying that there are two approaches: global formulary apportionment approach and arm's length price approach. And what we have adopted is the arm's length price. So OECD has adopted arm's length price approach as the principal approach, and almost all the jurisdictions, they also follow the arm's length principle or arm's length price approach. So what is arm's length principle? In simple terms, the arm's length principle is the principle that transfer prices between related parties should meet the arm's length test. And what is arm's length test? The process of comparing the actual transfer price, or say the transaction price, with the arm's length price is referred to as the arm's length test. Now this takes us to the question, what is arm's length price? Arm's length price is the price that is paid in comparable transaction between unrelated parties. So this is, the most simple definition or meaning of arm's length principle. So what is arm's length principle? That transfer price should meet arm's length test. What is arm's length test? That, to compare transaction with arm's length price. And what is arm's length price? To find out price paid in comparable transaction between two unrelated parties or comparable uncontrolled transaction. So what happens in arm's length, the if we try to understand the meaning of arm's length principle and focusing on first two words, arm's length. So when we meet, the person who is not connected to us, who is not related to us, we generally try to maintain the distance of arm's length, And in COVID times, one may be maintaining the more distance. But the arm's length principle says when you are meeting with unrelated party or when you are dealing with unrelated party, you are maintaining certain distance, and that distance is generally arm's length, which means the relationship is not impacting the distance. So the law or the regulatory bodies, they want you to adopt a price which is not getting impacted by the relationship between two companies or two transacting parties, and that price is certainly a price at which you have done transaction with third parties. So this is what the last bullet is saying. The arm's length price is the price that is paid in a comparable transaction between unrelated parties. So what price we need to adopt? Not only a price, between two unrelated parties, but also, that price should be comparable. So there should be, comparable circumstances. The transaction should be comparable. Then only we can pick up a price or a profit under the arm's length price approach. So what we do in this case in arm's length price, it's kind of replacing the actual terms, that is price, etc., under which a transaction was done with the arm's length terms, and for tax purposes recalculating the profit accordingly. So let's say if you have exported goods to your associated enterprises for $10 per unit, and the arm's length price of the same goods comes to be $11 per unit, then for the purpose of tax, instead of taking $10, one needs to take $11, which will increase the income in the manufacturing country or the country which is exporting. So this is how the arm's length principle is followed and adopted while computing the tax for the purpose of when you're filing your income tax return. Now this takes us to the question or to a slide, that okay, Now we are clear on the meaning of arm's length price. We are clear on the meaning of arm's length principle. What if TP law is applicable on me? So I'm not going into much detail, when the law would be applicable, just broadly to understand, it is applicable when there is a transaction between related parties. Those related parties could be, domestic, and those related parties can be, one is located in one country and another is located in another country. So depending upon jurisdiction to jurisdiction, you will find that transpricing law is applicable in domestic transactions as well as international transactions. But what I understand primarily in most of the countries, transpricing is applicable when it comes to international transactions, and very few countries is having transpricing law within the domestic for the domestic transactions. So, but when your transaction falls within the purview of transpricing, then what is the process that we follow? So it's the 8-step process, that I generally follow while doing the transpricing analysis and while documenting the same. So the first step, if you can see, is taxpayer analysis or taxpayer review. So what we do in taxpayer analysis or taxpayer review is, we try to understand, the equity structure of the taxpayer, the business of the taxpayer, in which industry that taxpayer is operating, what are the related entities, or who all are the associated entities, and what is the position of the taxpayer within the overall group. So that's what we try to broadly understand in the first step. So after the first step, one is clear, okay, this is what my taxpayer is doing, this is what the group is doing, and this is how my taxpayer is contributing to the group. And also, it's comparison with the industry. So let's say if you belong to a particular industry, then how that industry is operating, what are the key characteristics of that industry, what happened during the year. So what should be, the profitability of your client, depending upon that industry analysis which you're doing. So from this, you get a grip, one gets a grip on the taxpayer. So once we are clear on the taxpayer, then we move on to understand the transaction. We call it transaction analysis. So the transaction herein means transaction between the related parties, or sorry, transaction between your assessee, your taxpayer, or your client and its related parties or group companies. So you need to understand various terms and conditions of the transaction, the characteristics of the goods or services which are transferred in the transaction. One needs to carry out functional asset and risk analysis of the transaction. So this functional asset and risk analysis is very important. What we do in FAR is, we try to understand what both the transacting parties, how they have contributed in the transaction. What are the important functions performed by each entity in the transaction? What are the assets employed by each entity in the transaction? What are the risks, the entities are taking in the transactions? And then we do then we do the characterization of the entity or of the transaction. So for example, how this transaction analysis assists us. Let's say we have got, for the sake of simplicity, let's say we have got two entities, one is operating in India and second is operating in Middle East or UAE, let's say. So now the brand name, the design of the product belongs to the Middle East entity, and that Middle East entity is also involved in marketing of the product. That Middle East entity is also involved in setting up the price of the product. So what Indian entity is doing is only doing the manufacturing of the product. Now, based on the design received from the Middle East entity, based on the composition, both internal and external design, the type of material that will go into the manufacturing, based on whatever, all this nuance, I will say all the based on various information received by the Indian company from the Middle East company. The Indian company manufactures the product and exports that product to the Middle East company. Middle East company puts its logo, and that may happen also in India, but that logo or the brand name or the trademark belongs to Middle East company and not to the Indian company. So once the good is received from the Indian company by the Middle East company, the Middle East company starts marketing the product, starts selling the product. So in this transaction, if we see, that then what India is doing, India is only acting as a captive manufacturing unit, whereas the Middle East entity is acting as entrepreneur entity, taking most of the functions, doing most of the functions, taking most of the risk. Now, if we the benefit of this transaction analysis, as I said earlier, we are able to characterize the entity, or we are able to characterize the transaction. So by doing the FAR analysis, we are clear that okay, India is the least complex entity. What India is doing, India is only manufacturing and exporting it to Middle East. So we can take India as the tested party. We can remunerate India on a cost plus model. So instead of justifying the profits of Middle East entity, it would be better to justify the profits of India, because the Middle East entity is involved in doing a lot of functions. It's a very complex entity, so it may have profit, it may have losses. The profit may go up and down. So when it comes to benchmarking, which we're going to discuss as we move forward, but one can certainly take India to benchmark the profits, because India is not doing much functions. India is pretty simple, less risk, less complex. So it would be easy to benchmark Indian entity vis-a-vis the Middle East entity. Then the next step is setting comparability standards. Once we are clear on that yes, we can take India as a tested party, then we can set the standards. The standards for comparability could be, let's say, the comparable entity needs to be the manufacturing entity, and needs to be the manufacturing entity. Secondly, it must be into manufacturing of, let's say, the garments, for example. That entity should involve in the exports. That entity should have certain type of, I will say certain category of sales turnover. Then that entity is not involved in doing marketing. So all these parameters can be built up. All these comparability standards can be built up. Now, when it comes to comparability, we have broadly two kind of comparables. One is internal comparable and external comparable. So these three steps, setting comparability standards, internal comparable and external comparable, are very much correlated, though each step is dependent upon each other, but somehow they are more mixed. So internal comparable is something, when you can find the data within the group. External comparable is when you are not able to find the data within the group, you look for the comparable data outside the group. So it may also happen that you do have comparable data within the group. That is, you do have internal comparables, but you still look for external comparables. That's okay. But it is said, when you have internal comparable, it is considered better than the external comparable. So the first try, or the first attempt should be always to identify internal comparables based on the comparability standards that have been set after doing the transaction analysis. Now, when we are working on internal comparables and external comparables based on the comparability standards that we have set, we need to choose the most appropriate method. Now, when it comes to the most appropriate method, we have price-based methods and we have profit-based methods. And the comparability standards for both price-based methods and profitability-based methods varies. So the degree of comparability becomes very high, or needs to be very high, when we are comparing the price. Whereas as we move down towards the profit, the degree of comparability relaxes, it relaxes in comparison the degree of comparability that is required for price comparison. And when it comes to, when we are saying that we need to have most appropriate method, it do means that we're going to evaluate each method independently, and why a particular method is not applicable, why a particular method is applicable, that needs to be documented. So once we are done with our analysis, once we are able to find the comparables, we need to do adjustment if it requires, because sometimes you may get exact comparable, sometimes you may not get exact comparable, and if it is possible to carry out reasonable or accurate adjustment, then one must do the adjustment to the price, to the transaction, to the comparable transaction. And then we need to conclude whether the transactions are at arm's length or not. And when you document this entire process, we get a documentation, we get a TP study, and this process which I have shared with you is primarily for the local file. So we have three type of documents I'm going to cover, but just for the sake, because we are in this step. So this TP process is directly related to your local file or the local TP study that one needs to prepare. So when you document all these steps, you document taxpayer analysis, transaction analysis, setting comparability standards, internal comparison, external comparison, choosing most appropriate method, doing adjustment, and then finally concluding. When you document this, it becomes your TP study. So now let me move on to transfer pricing methods. So we have 6 transfer pricing methods. One is the CUP, comparable and controlled price. Second is the resale price. Third is the cost plus. Then we have transactional net margin method. Then we have profit split method. And then the last is the residual method. So we're going to discuss each method one by one. So let me start with the first method, which is CUP, comparable uncontrolled price method. So in this method, CUP, comparable uncontrolled price method, we focus on price. We try to compare price, and that price should be uncontrolled, means it should come from transaction between two unrelated parties. And for that matter, each, if I talk about any of the method, the price or the profit should come from uncontrolled transactions only. And such uncontrolled transaction should be comparable. Okay, so it should be comparable, it should be uncontrolled, and then we will going to compare the price. So if you see, prices is such a point, wherein buyer agrees to buy and seller agrees to sell. So before comparing the prices, we need to compare terms and conditions which actually went into fixing up the price. So price gets impacted by a lot of factors. If you take any product, if we take the, let's say, example of the jacket which I'm wearing, so the fabric will have impact on the price. The branding will have impact on the price. The season in which I am buying the jacket will have impact on the price. The packaging will have impact on the price. The where I'm buying this product, whether I'm buying this product online or whether I'm buying this product from a mall or whether I'm buying this product from a small retail shop, it will have an impact. Then it could, we may see, the impact because of quantity also. So if I'm buying one jacket or if I'm buying, let's say, 50 jackets, it may have impact. So price is very sensitive. So when you are comparing the price, it becomes important to compare all the factors which are impacting the price. And once we are sure, that we have compared the various factors which are impacting the price, then only it is good to go. It is said that one should apply the CUP. CUP is the, I will say, one of the best, not one of the best method if you have data availability of comparable data. In general, the comparable data is generally not available at the CUP level unless you have internal transactions, if you have internal comparable. It is tough. My practical experience is it is tough to find CUP data from external comparables unless you are dealing in a commodity or services which are listed on an exchange. Then the next method comes resale price method. So resale price method is actually a method which we use to remunerate a trading transaction in the group. And that trading transaction, the trading entity should not be adding much of the value to the product. So for example, let's say we have a manufacturing unit in KSA in Saudi, and that manufacturing unit has got all kind of intangibles. The KSA unit, the KSA entity have all kind of rights. KSA entity is fixing the price of the product, and it do have a subsidiary company in UAE, and that subsidiary company in UAE is primarily into distribution. So the KSA exports the goods not only to UAE but also to other countries in the region and outside the region. Now let's see how to benchmark this transaction between KSA and UAE company. So now this UAE company is primarily involved in the distribution, whereas KSA is doing all kind of functions. So if we see the least complex entity, then Dubai or UAE entity would be the least complex entity, and we can take UAE entity as a tested party, and now we can apply the resale price method, which is also known as RPM method. So under this, we will going to benchmark the gross margin earned by the UAE entity. So because UAE is doing the least complex function, so UAE becomes the tested party. We'll see what is the gross margin earned by other distributor companies, other comparable distributor companies in UAE, and what is the gross margin earned by the related party in UAE. And if the gross margin earned by related party in UAE is within the range, within the arm's length range, then one can say, okay, the transaction between KSA and UAE are at arm's length. Now, this takes me to the third method, which is cost plus method. I will go back to my example, which I took, where in India was a manufacturing entity, and the company in the Middle East was the entrepreneur unit. So in cost plus, we remunerate the manufacturing entity or the entity which is providing the services on cost plus basis. So what we do, we find out the cost and then we add a markup on it. But it is important to find the least complex entity, and that least complex entity, what we call tested party, should be involved in doing the manufacturing or service functions. And then we identify the direct and indirect cost of production or services. We add markup on the same. The markup comes from the arm's length range. So in our example, what we took is, was basically the India was a manufacturing unit and exporting the goods to the Middle East company, and Middle East was having all the rights, design, functions. So what India was doing is India was only manufacturing the goods. So we said, okay, we can take India as a tested party. We'll see the direct and indirect cost of production of India, and we'll find the comparable companies. What are the margin, what is the range of arm's length margin in that jurisdiction. Based on that arm's length range, we'll add the markup, and that price will become the arm's length price or arm's length markup. So in RPM, this is resale price method and cost. So I think it should be RPM and not RSP. Sorry for this. It should be RPM and not RSP. Let me do correction here. No, somehow it is not working. Okay, sorry, somehow my system is showing some error. So it should be RPM and not RSP. So we have understood RPM, CPM, and comparable uncontrolled price method. So in RPM and CPM, what we're doing, we are identifying the least complex entity and we are remunerating least complex entity. In RPM, the least complex entity is the entity which is involved in distribution. In CPM, the least complex entity is doing the manufacturing function. So now what happens, when you don't have internal comparable, it somehow becomes difficult to apply resale price and cost plus, because one may be having different the cost base. uh, so cost base could be different, or denominator could be different. One may be following the different accounting practices. One may be doing certain functions, which are not adding great value, but the cost to that functions may be, one may be recognizing at the gross level, the another comparable company may be recognizing at the net level. So the profits at the gross level may vary because of because of the difference in accounting practices or difference in the recognition of cost. So what we do, we go to TNMM. So instead of benchmarking the gross profit at the resale price method or cost plus method, we use transactional net margin method and benchmark the net profit. So it is said that TNMM is more flexible towards the uh, difference in the functions, whereas in resale price and cost plus method, the functional comparability is high. So if you talk about cup, I was talking when I was discussing about the comparability standards, I said, it changes as you changes the method. So comparability standards is pretty high when we talk about the cup. Then it goes down to RPM and CPM, because in RPM and CPM, product comparability is not very important. Function comparability is very important. But when you move on to TNMM, again, the product comparability and functional comparability goes down. And then towards the end, we have a profit split method. As the name suggests, what we do, we try to split the profit. So wherein, let's say, two entities are working together and they're contributing to a project, and both entities are bringing the intangibles. So we try to apply profit split method. Generally, we have two, I will say, two approaches to apply profit split method. One is the total profit split method, and second is the residual profit split method. Under total profit split, we compute the total profit earned in a transaction. So, for example, let's say the one entity, let's say, has invested or has incurred $100 as the cost. The another entity has incurred $80 as the cost. So total transaction cost is $180. And now the revenues from $180, let's assume it to be $220. So the total profit would be 220 minus 180, that is $40. So this total profit, $40, is divided between two entities depending upon the arm's length approach. In the residual profit, what we do, we see, okay, you may take first the normal profit that you generally earn, or normal profit based on the arm's length scenario. So let's say the normal profit, you know, let's assume is 5%. So first you will divide 5% among each entity, and then whatever the residual profit that you are left with, that gets divided among different participating entity. This is what we do in profit split approach. Then we have the last method is the residuary method. It is the recently added method in the OECD list. So, wherein we are not able to apply any of the five methods, we apply the residuary method. So it gives the flexibility to the tax authority and the taxpayers to benchmark the transaction using some formula or some valuation technique, because there are some transactions for which you may not be able to find the comparable. For example, if you are transferring the intangible, or if you're selling the intangible from one entity to another, how you will find the cup, because every intangible is unique. To find a comparable price data would be tough. So none of the entity, we can say, as far as intangible is concerned, is involved in the trading of intangible or is involved in manufacturing of the intangible. Similarly, we cannot apply the TNMM, we cannot apply the profit split. So how to benchmark a transaction which involves transfer of intangibles? So in that case, we may shift to residual method. Now let me move on to discuss TP documentation. So now after BEPS action point number 13, we have three kinds of transfer pricing documentation. One is the local file, second is the master file, and third is the country by country reporting. So generally local file, which we generally call TP study, is applicable in most of the companies. Then the master file, and then we have country by country reporting. So these are the three documents which comes under the transfer pricing regulations, which needs to be prepared by the company or by the taxpayer, by the multinational group. The applicability may depend upon country to country, that one country may have certain thresholds for local file, may have different thresholds for master file, and for a country by country reporting, generally it's we try to follow a global threshold, but still we may say some 5-10% up and down. So, and few countries may do not have even a threshold for the master file or local file. So now the content of the local file I have already discussed with you broadly, when I was discussing the TP process. So when I was discussing the TP process at that time, I already discussed the content of the local file. So these are all basically the content of the local file at a broader level. Now let me move on to discuss the content of the master file and country by country reporting. So master file is expected to provide an overview or blueprint of multinational groups' global business model. So local file focuses on the local transaction, on the local company, the company which is operating in the jurisdiction, whereas master file gives you a very good bird's eye view about the group, about the entire group, or a blueprint about the entire group. So it generally covers following aspects: organizational structure of the group, description of various business lines, intangibles used in the business, intercompany financial transactions, and financial and tax positions. So few examples, I can share with you. So when it comes to organizational structure, what are the different entities, how they are linked to each other, what is the ownership linkage. When it comes to business lines, what are the different businesses group is into, what are different products and services, different geographic markets, key competitors, different business models adopted by the group, key strategies, description about the supply chain of those businesses, products and services. When it comes to intangibles used in the business, list of all the intangible assets, their name, the entity, those who have got the legal ownership right on those assets, the strategy for developing those intangible assets, what is the transfer pricing policy followed for transfer or use of intangible assets. So there's there could be more information. I'm just sharing a few examples of such information that are required in the master file. When it comes to financial transactions, identifying the entity that provides central financing function, key lenders to the group. These all information needs to be compiled in a master file. Then what are the financial and tax positions, if the company has entered into unilateral or multilateral APA, any some key judgments on the company, that all needs to be documented under master file. One important point that we need to keep in mind is that your master file and your local file should be in sync. So, for example, let's say uh, you have got entity in KSA, and you have got entity in Middle East, and you have got entity in India. Now, let's say the Indian entity is providing services to KSA entity of IT services to KSA entity on cost plus basis. And the KSA entity is doing manufacturing and distributing goods uh, to the Dubai entity, to the to the UAE entity. Now, if we see the benchmarking process, from India perspective, let's say we use cost plus method to benchmark the transaction. Uh, though in UAE we do not have the local file right now, but let's assume, for from the UAE perspective, what we did, we used RPM and we benchmarked the transaction. In KSA, we did the benchmarking on the company as a whole basis. So the consultant felt it would be easy to benchmark the profits of the company rather than benchmarking each entity separately. Now, when you are preparing the master file is prepared from the perspective of transaction. So we are saying, the services from India is benchmarked on a cost plus basis. The trading transaction with the UAE is benchmarked on a RPM basis. Now, this see, master file is not in sync when it comes to KSA TP study. Though master file is in sync when it comes to India TP study and UAE TP study, but it is not in sync with KSA TP study. So when you are preparing the master file, generally the master file is prepared by the headquarter, and but when you are preparing the master file, it is important to understand the functions, the contribution of each entity. So one needs to be in touch with the local consultant or the local entity. And when the local entity is preparing the TP study, they need to keep in mind the position taken in the master file. Now, let me move on to country by country reporting, a very important provision, but applicable on not many companies. So basically, CBCR presents jurisdictional wise crisp information about M&Es. It primarily includes revenue earned from related and non-related parties, profitability, income tax, capital and accumulated earnings, number of employees and tangible assets, main business activity of various constituent entity of the group. So if I talk about these first three bullets, the format is in the table. It's a tabular format which is released by the OECD. Uh, these three bullets, one needs to give the jurisdiction wise data. So if in jurisdiction you have more than one entity, so we'll club all the entities, and we give the clubbed data, and not data entity wise, but data jurisdiction wise. But when it comes to main business activity of various constituent entities in the group, so we not only give data jurisdictional wise, but in each jurisdiction, different constituent entities and what functions they are doing. So this is what we do in CBCR. Now let me move on to outline of TP regulations in the Middle East. Kind of a bird's eye view how the Middle East is going. So in TP compliances, transfer pricing compliances, we have local file, we have master file, we have country by country reporting, and we have RPT written form. So if I talk about Bahrain, there is no transfer pricing regulation as on date. However, country by country regulations are expected soon. If I talk about Egypt, we do have local file, but there is no minimum threshold. We do have master file, but there is no minimum threshold. For CBCR is 3 billion, and this we do have RPT written form. If I talk about Oman, in Oman we have only country by country reporting for the threshold of turnover of 300 million, and no other compliance, that is local file, master file, or RPT written form. When I talk about Qatar, we do have local file, we do have master file, we do have CBCR, and we do have RPT written form. The threshold with regard to local file, master file, and RPT written form are expected soon or is expected soon. When I talk about Saudi Arabia, we have local file and the threshold is SAR 6 million. So now the local file says that the law says you need to maintain local file if you have transaction value more than 6 million. But it is mandatory to compute the arm's length price for each transaction. Similar threshold for master file. For CBCR, it is 3.2 billion, and we do have RP written form. For Turkey, we do have local file, we do have master file. For local file, there is no minimum threshold. For master file, there is 500 million. For CBCR, 750 million euros, and we do have RP written form. When it comes to UAE, we have only CBCR regulation as on date, and the threshold is AED 3.5 billion, and we do not have local file, master file, and RP written form. With this, I think I'm on for Q&A session. Anu, over to you.
Thank you, Gaurav. So that was all. We'll be taking in questions now. So the first question we have here is from a YouTube viewer. His question is: if I'm an entity in UAE having a subsidiary in Saudi, what transfer pricing obligations I have?
So if you are holding entity in UAE and subsidiary company in Saudi, so as I discussed that currently in UAE, we do not have transfer pricing regulation except CBCR. So from UAE perspective, we need to see that global turnover is around 750 million euros, but TP regulations would be applicable from Saudi perspective, because if you see in UAE, we have only CBCR, which is AED 3.15 billion. So if your group turnover is more than 3.15 billion, then you will be having country by country reporting application. If that is not the case, then in UAE, you do not have CBCR regulation. You do not have applicability of CBCR. But if I talk about Saudi, from Saudi perspective, because you do have entity in Saudi, it may be a subsidiary company, but you do have entity in Saudi. And if that Saudi entity is paying corporate tax, then this transfer pricing regulation is applicable on the Saudi entity. And if transaction values is more than SAR 6 million, then one needs to maintain the local file and master file as well.
Okay.
As far as CBCR is concerned, I would like to clarify, as far as CBCR is concerned, it is generally happen that, ultimate parent entity or the ultimate reporting entity prepares the CBCR report, and the another entity files, kind of a return or kind of a intimation to the tax authority that my ultimate parent company or my ultimate reporting entity is preparing the CBCR, and here are the details of the ultimate reporting entity. So one entity in the group prepares the CBCR, and other entity in the groups, they file the intimation.
Thank you, Gaurav. We have one more question. Question is, if I have some business connections with an unrelated company outside the UAE, but that company has common directors with our company, do we have any transfer pricing obligations?
Anu, I'm sorry to say it would be tough for me to cover each regulation very specifically, but because they are talking about the UAE, and in UAE we do not have transfer pricing regulation, so it would be simple to answer this question at least, that just because you have a business connection and there are common directors, I think in TP, when it comes to TP, just because you have a common director, you generally do not become the related party. What is important is the control, the whether because of those common directors, there is a control in the entity or not. So I think each regulation, each country comes up with their own definition of related party. So it would be tough for me. I'm sorry to say to all the audience, it would be tough for me to talk about each regulation specifically in this webinar. But when it comes to UAE, in UAE we do not have TP regulations, so nothing to worry.
We have one more question. Gaurav, question is, Attribution of profit under transfer pricing has been based on the functions, assets, and risk analysis. How do you see this undergoing a change under the current scenario, uh, under the current environment?
Under the current environment, see, still the thing, the attribution will going to happen based on function, asset, and risk analysis. I do not see any change. The change would be, because of the lockdown or because of the COVID scenario. The change could be in the functions. If the change is in function is temporary and it's because of the lockdown, the countries may come up with some relaxation, but otherwise, normal principle of arm's length attribution would going to be followed.
I think we
Anu,
have
your voice
few.
is not audible. Yeah.
Is it clear now? Yeah.
Yes, yes, yes. Okay.
Okay. So I think we can take one more question. We have few minutes. We can take this last question. Question is, do you think that a robust safe harbor mechanism is the answer to counter harmful transfer pricing structures?
See, my experience is there are safe harbor regulation in different countries, but do safe harbor actually counter transpricing issues? I do not feel. What safe harbor only does is, it avoids litigation. So it helps companies in avoiding litigation who wants surety. So if some entity or multinational groups follow safe harbor, so under safe harbor, there are certain assumptions that you are doing this kind of activity and this is your probable FAR. Based on that, safe harbor says if you are earning this much of a margin or if you are following this much of a policy price strategy, uh, then there would not going to be any addition. Uh, so, but that only helps in mitigating the litigation and not transferring mischief.
I think it's almost 12, so we'll be closing in now. You can view a recording of today's webinar on our YouTube channel and on GCC FinTech's webinar page. I thank you all once again for joining in, and I look forward to your continuous support in making GCC FinTech successful. And thank you, Gaurav, for your time.
Thank you, Anu. Thanks to everyone.